Dun, 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 dun. Boy, do I got some news for you guys today. We're gonna go in the Wayback Machine, and it's gonna be awesome. Look, stock nerds, market lovers, really super interesting week with jobs report. Just the market itself in a shortened week, little hectic, price action wise, and we'll get to all that in a moment, and we'll set you up for the week coming forward to make this show not only informational, a little bit entertaining, hopefully, but more importantly, that it's practical application for you. Danny, this is a Danny-heavy show. You promised me you would be in studio. You're not in studio, so I planned a Danny-heavy show. So we'll see how that goes, and then we'll get cranking with Don, and then we'll get you going on your way here. But stock news, market lovers, let's start with Top Gun.
Let's start with Top Gun.
I was about to start with what this market pretty much is going to be hinging on, but it's a little heavy, right?
Sure.
Yeah, it's a little heavy. And so Zach walks in and goes, "Hey, did you see Top Gun?" And I'm like, "I don't care." And but my wife saw it and she loves it, and she's like, "It's the best movie ever." And then it got me thinking, does anybody die in the movie? Like I think
we can't talk about that on here. That's spoilers.
Is that spoilers?
Potentially.
Oh, I meant
a spoiler.
Yeah, the movie came out this week.
The biggest type of spoiler that you can have.
I can't say.
Main character died. Is that a spoiler?
I don't know.
Did Tom Cruise die? That's great.
I can't say. I can't. I've seen it. I don't know if you guys
I meant in combat. Because
right. Okay.
Yeah, I meant in physical warfare because Top Gun
That
seems to. Because Zach says, yeah, it's a safe movie for the ladies, not a lot of blood and guts.
I know a lot of chicks that like it. It's weird.
And I'm look, I'm like Beyonce, all the single ladies. Like I don't care for all the blood and guts.
Sure,
but
we'll put it this way: if somebody was talking about Top Gun 1 and they said, "Oh, you haven't seen it?" Oh, yeah, well, Goose dies. Would that be
we're back to this?
You can't open
can we just
title
title
who dies in it?
Yeah, can we just title this part of the show? Tim doesn't know what a spoiler is.
No,
because that's funny.
Yes, we can.
Yes, we can. I think we have the technology, gentlemen.
Yeah.
That's a $6 million man reference.
Is that what it is?
So, hell yeah, it is.
But Top Gun, dude. Who was the fall guy played Bionic Man? Who was Bionic Man?
I have no
Steve
idea.
Austin.
Wow,
dude,
Danny.
Lee Majors. Yes, thank you. Thank you. Yes.
Steve Austin was
and Lindsay Wagner was the Bionic Woman. Yeah.
Mm-hmm. Jamie Summers.
Yeah. Oh, what's that? Jamie Summers.
Her name, Jamie Summers. That was her stage name.
She had super hearing.
Her character name.
Yeah, she had good hearing. Yeah. So anyway, Top Gun is the A-Team. Nobody died in the A-Team. Is that a spoiler? I don't think if you watched the entire episodic run of the
Never
A-Team,
once.
I don't think
no
anyone
guest star, no special guest.
I don't think anybody has ever died in. And now that we're talking about it, I think the A-Team and the Incredible Hulk are really the same show.
We're really spinning off in obscurity here.
No, think about it. They were both the Incredible Hulk was being tracked by some army dude, right?
Sure.
Like trying to capture him, like, hey, you gotta bring him back.
He's a scientist with gamma radiation. The A-Team is America's elite fighting force.
Yeah, but the A-Team was being tracked by probably the same army dude from the Incredible Hulk. Couldn't get the Hulk, so he's going to get the A-Team.
Well, it's one America, one army, I'd assume, across shows.
Top Gun, man, most popular movie in the world.
You should go see it. It's good.
Zero desire. I zero desire to go see it.
Hey, look, it's only 2.5 hours. The ticket's only going to cost you $24.
That is a long time to sit still.
You're gonna love it.
So Danny, this is where the Danny part of the show becomes interesting. So let me show you something here. So where do I want to start? I want to start it here. So Janet Yellen gives me a mea culpa this week. She says, I was wrong. And let's not be cynical to the point where we don't say, hey, somebody admitted they were wrong, right? But she failed to see what like 99% of Americans who go to work every day, shop for food every day, put the kids through school every day, saw a year ago. Which really, maybe we want to talk about the isolation that some of our public officials might be encountering when they live their daily lives because they don't live like the rest of us. You ever see that part in People magazine, Zach, where people like stars, they're just like the rest of us, you know, like, and it's a little People segment in the People magazine. Now they do it online. Yeah.
How does Jennifer Aniston look so good at 50?
Yeah.
She's just like the rest of us.
Yeah. Janet Yellen, not like the rest of us. Joe Biden, like none of our government officials are like the rest of us. They don't go to the Piggly Wiggly to pick up their spam. they're getting beef bourguignon,
right.
which is Julia Child's most favorite famous dish. Okay, so now Janet Yellen says she was wrong. But here's the thing, Zacharewski, Danny Ruski. Here's the thing. In an interview with Becky Quick, and I've kind of highlighted it there, efforts at, let me just get my cursor so people can see this. I'm going to link to everything like I always do in the show. Prescription, they're going to try to bring the cost down of prescription drugs, and they're going to try to get more pumping of oil. Can I just tell you an oil story real quick? So OPEC yesterday morning, today's Friday. What is today's date? The 3rd.
Yep.
June 2nd, news opens. OPEC going to pump more. And I'm like, oh, maybe that lowers the price of oil. It does not lower the price of oil. As a matter of fact, I'm picking up the kids from daycare, sitting across from the Kroger, and I'm like, God, gas is $4.45.
Yeah.
And I know there's other states higher. Don't yell at me. All right.
Having heart palpitations in the parking lot.
Right.
Yeah.
And so I'm like, but it was lower last week before we were going to pump more oil from OPEC, right?
Sure.
And as I'm sitting at the stoplight, it literally went to $4.75. And I'm like,
you saw it change live?
I'm like, what the hell?
Yeah.
Like, what happened at whatever time I'm sitting at the stoplight? Hey, we just got the word going up.
Like 1973 all over again.
Seriously, it's nuts. But here's the point, right? They're going to try to do everything. And look, I am pro consumer. Like, I'm just like you at home. I am like you at home. I would enjoy lower gasoline prices, food prices, daycare prices, everything prices, right? I would enjoy that very much so. So I am not living.
Of course. We should make everything cheaper. Why not?
Right.
Yeah.
So here's the thing. This isn't going to fix the inflation problem. And this playbook has already been written. So little known fact, Zach, I have trouble sleeping. Got a lot going on, right?
Is that a little known fact?
Little known fact. So you can go to My Screen and Me. My Screen and Me sounds like a Teddy Ruxpin commercial.
My Screen and Me.
My Screen and Me. And so they want to bring prices down. And right away when I read that the other day, I'm like, this is a stimulative effect to the economy, which is kind of a problem. And I know it sounds counterintuitive, but if we somehow pump more money into the economy, it's going to have a stimulative effect. And that's kind of what we don't need right now to get this inflation under wraps. And so I think Tom Jarrell and Danny, this is where I don't think we can get Danny. Can we get Danny on the lower right-hand corner? Can people see Danny and Tom Jarrell?
Give me a minute. Yeah, I can do that.
Okay, I'll keep talking.
Yeah, go ahead.
And so, because Paul Volcker is going to come on the screen here in a second.
Sure.
And he's going to explain this much better than I can, okay?
Yes.
But Danny, who was Paul Volcker?
He was the Fed chairman in the early 80s. Carter appointed him to kill inflation. So he took interest rates up into double digits and killed inflation.
Okay. And so,
and the economy.
Yeah, but that's what he had to have: demand destruction. He had to create demand destruction to get inflation under wraps, so you could get that beautiful 1982 through whenever run in the economy. I don't know if that's where we're headed, but whether it's direct payments to people, whether it's a relief, and we've talked about it, of college debt, which will be very, very stimulative for a bunch of people. Like, I'm all for that. I'm pro people. But if inflation is the issue here, and the Fed's only done 2 rate hikes, and they really haven't started tightening. We're going to get that in a second. We're in a little bit more trouble here, and I think we're on a path to S&P 500 to 3,500. S&Ps are trading considerably higher than that right now. You ready for me, Zach?
Sure.
Yeah, pop me up with the sound. So little known fact here. I don't fall asleep. I said that before I opened this segment. Where Graham, Graham's going to be 6 months old this month. Crazy. And so Graham, though, is ill. And so we are taking care of Grahamster and feeding him. And so it leads to some very late nights. And so I'm like, what am I going to use to fall asleep? I don't know. I open up the YouTuber. It's got an algorithm for me.
Sure.
And it feeds me the It feeds me the complete weekend broadcast from, where's my marker? Oh, my marker doesn't work on here. Okay, that's all right. We're cool. So I guess my marker's not engaged. Oh, I didn't start my marker. That's fine. It feeds me the complete broadcast from February 1st, 1981. Let me take you back in case you weren't born yet. I was young.
Paint the picture.
I might have been 4
Put
or
us
5.
in the time machine.
So we go back in the time machine, right? In the Wayback Machine.
Yeah.
And Reagan has just taken office on January 20th, January 21st of 1981. He's barely been in office, okay? And Tom Jarrell, weekend anchor for World News Tonight. This is before Frank Reynolds. Frank Reynolds got ill and passed away. Peter Jennings and some other fellow, I can't, Steve Robinson or something, did the broadcast, okay?
Mm-hmm.
Tom Jarrell's weekend anchor. And they get Paul Volcker. You ready?
Yep.
Let's do it.
A major part of the ongoing battle to control inflation has been the tight money policies of the Federal Reserve Board, which have also driven up the prime rate. Today, the chairman of the Fed, Paul Volcker, was asked by ABC's Barry Seraphin if he expects to ease the money and credit squeeze soon.
We don't intend to ease up in the sense of permitting more rapid growth of money and credit, because that would reinstitute the very problem we're trying to deal with.
Think about that. What he just said is so critical to understanding what's taking place right now in 2022. We can't do anything to ease the burden. Let me read between the lines here. We cannot ease the burden on the consumer. We cannot do anything to take your pain away, because if we do, it's going to exacerbate the problem to which we already have. And if I'm not mistaken, Danny, Paul Volcker said that with almost a smile on his face.
He was on TV.
What is that your take, Daniel?
Well, he did what he had to do, and now they're going to have to do something here. What scares me is the Biden administration was talking about, these evil oil companies price gouging, and I'm worried they're going to try to price fix, which is what they did in 1973 with the oil embargo. All that did was drive prices higher. So if you start price fixing, or you try to do political programs to help ease the burden, that just still causes it may make it even worse. But yes, the Fed cannot ease up right now, because if you start giving money, if you start handing out money again, that was the problem in the first place, you're going to cause inflation again. So every time you hear them say, we're going to curb demand, whenever you hear those words, curb demand, that means putting people out of work and causing pain. Just replace it with putting people out of work and causing pain.
Yeah, this is a really tough situation, because the jobs report came out today, and it wasn't so bad. Whatever the number is, like 300,000 jobs created. The employment participation rate ticked up, which is a good thing. That means more people are coming off the sidelines. And they're probably, if we're being honest, they're coming off the sidelines to do what? Fight the effects of inflation. They need more money to live the standard of quality of life to which they're living. But we're only 2 rate hikes into this thing. This thing is far from over. It's probably not going to be until another, 12, 18 months? They have to kill. The jobs aren't coming down, and that's a great thing. This isn't a bad thing. You don't want people to be unemployed.
Yeah, ideally.
But it's wage inflation that's a big component of our inflation issue. And I'm all for people getting paid more. I don't know how they fix this, Danny, without creating such a mess that they then come back in to stimulate it. And let me just put it a little bit more in perspective, and I'll get Danny's thoughts on this. In times of slowdown, what the Fed normally does is they loosen monetary policy. And let me show you what that looks like on a chart. So they loosen monetary policy. And what does that mean? The money supply goes up. And so, what does that mean, Tim? And so if you look at my screen, Zach, can you zoom in so I don't have to?
Yeah, a little bit.
Thanks, man. So look at the money supply increasing. There's 2016, 2018 market generally an uptrend. But then we hit 2020, right? And we all know pandemic hits. And what did the Fed do? They just skyrocketed the money supply up. They loosened the supply of money. And what the markets respond with? Huge moves higher. After downdraft, right? The Fed comes in and says, oh, big downdraft. We better stimulate. So they stimulate, and then you get where we're at. And it's super interesting to me. And as I zoom in on this chart, what you're going to notice is, Don, what is the NASDAQ down year to date right now? Like 22, 23%?
1 second. It is down 21%. Well, and then add 2.4% for right now. So
okay.
23.4.
Okay, 23.4%. This is the small blip that we've had to the money supply to date. That's it. That's the only blip we've had, and we're already down in the NASDAQ 23.4%. If they continue to go down the path that they're on, I think we need to listen to what Paul Volcker said in 1981, because this thing is far from it. And now, Danny, here is where we get into the I read something and Danny comments on it. You ready, Danny?
Sure.
Man, this is going to be so great with you in studio, but we'll make the best of it. Let me show you this. Zach. So there's been a lot of, I don't know if there's been a lot of questions. I feel that the amount of people that are concerned about this, I mean, everyone's concerned about the economy, but I feel the people that are concerned about the triggers, and what's going to happen over the course of this month is like a small, minute part. Like, I don't think it's a very big piece. And that's that, but that kind of goes to what we do here at Revere, right? Like, it's about 53% of Americans take part in the stock market. Like, this much of that, 53%, right? As far as the eye can see, is probably passive 401ks, IRAs, right? Through your work, you just because the whole industry doesn't act in the way we do, right? We're not asset gatherers, we're asset protectors, where we're so concerned. Of course, we want a great return, but we're always first and foremost your asset protectors, meaning we want to return your capital before we want to return on your capital. We want a great return on your capital. But how many people, with the NASDAQ down 23.4%, the S&P is down what, Don, 13, 14%? How many are wishing?
S&P is down, yeah, 14.
How many people wish they had asset folks like the folks at Revere right now? The Fed, we can't stress this enough. It's not alarmism. The Fed is not your friend here. They are not going to be your friend. We are in a, Paul Volcker steered the ship. Janet Yellen is no Paul Volcker. Jay Powell, I'm not sure, is a Paul Volcker. I mean, time will tell, history will judge. But right now, they have missed it greatly. And so now they need to overcorrect. And that overcorrection, unfortunately, is going to be extremely painful. And I'm not looking forward to it one bit. So, Danny, the Federal Reserve's portfolio runoff has just begun. This is just from yesterday, okay? Central Bank is going to exit $9 trillion from their portfolio. But the mechanics of it are super interesting. Danny, you're never going to, Danny will believe it because Danny knows all this. But it's the folks at home that don't know this. So let me just scroll slowly. Okay, the Federal Reserve is going to shrink their $8.9 trillion portfolio. Here are answers to the 5 most commonly asked questions about how it's going to work. It's the mechanics. And it gets confusing because of the way the news reports it. I'm not 100% sure that everybody else understands it on the news either. When the Fed shrinks their portfolio, is it selling bonds? And so this is interesting. So, Danny, I don't know if you did know this. No, the Fed isn't selling bonds. They're letting them expire. So this is a big difference. Can you keep it up, Zach, so Danny can read it? So it's a big difference. They're not just going into the market and selling. They're just letting them expire. And it started just this month. It started on Wednesday. They're going to allow up to $30 billion in Treasury and $17.5 billion in mortgage bonds to expire or to mature every month without reinvesting the proceeds. By the way, this doesn't start until June 15th. So that isn't, you got to understand that, right? Like they're not going to go increase the money supply. They're going to let them expire. And so you might be saying, well, okay, what happens to that money? Oh, I think it's a great question, and I'm really grateful for this piece. So it's the question at the bottom here, underneath that ad. What does the Fed do with the money it receives from the payment of principals it's holding? Are you ready, Danny?
Yeah.
The Fed essentially created money out of thin air to buy the bonds. Now it will destroy the money in the same way. Go to Danny's shock.
Yeah, well, look, the easiest way to think about this is think about stock. So a company issues stock, and when they issue stock, the outstanding shares are the shares you can buy in the market, in the open market, right? Mm-hmm. The shares issued and outstanding. They still have some, quote, treasury stock, no pun intended, but they have some treasury stock that they have on the shelf that they can issue more of later and dilute existing shareholders, just like devaluing the currency.
Right.
Or they could go, when they do stock buybacks, they buy stock in the open market, which is bullish for that stock, but they buy back the shares and they stick it back on the shelf in the treasury so they're not in circulation. So when the Fed takes money out of the system, essentially what it does is, whether it just doesn't reinvest the interest and principal, or whether it literally buys back the bonds and not buys back, but takes the money out of the banking system, it can just stick it in this little vault, if you will, the side account. It just takes it out of circulation. That's what's known as the reserves. What are the reserves and the total money reserves, the money supply in the banking system? And so when they start sucking that money out, right now they're supporting the bond market, especially the Treasury and muni bond market. They're the biggest buyer by far. If they stop reinvesting and buying those bonds, a huge buyer went away. So now there's more supply and less demand. So the price is going to go down, meaning interest rates go higher, but the price of the bond goes down. That's going to put pressure on interest rates, which is not real good for the economy, but that's how they're tightening. So they tighten two ways. By declaration, they just raise the short-term rates, but then to control mid and longer-term rates, they stop buying bonds. That was called QE back in starting a decade ago. They call that quantitative easing. So they are no longer going to do any quantitative easing. And by the way, you, the listeners, probably thought quantitative easing disappeared after the economic crisis and then just was reinstituted a little bit during COVID and then went away. No, they kind of been doing it all along in different amounts. But they never, after the economic crisis, they never really completely tapered or pulled back. Well, now they're finally doing it because it's created this monster, and now they got to kill the monster.
This is such a different ball game than what's been played in the past. And this is a Fed-induced economic slowdown. Like the Fed created maybe the economy would have recovered naturally after COVID. They stepped in and did a lot of great things during that period, but they kept it going too long, clearly. And now here we are. And so some might say, well, they've already crashed a lot of tech and destroyed a lot of demand there. But they've got a ways to go. They haven't done the tightening yet. They haven't reduced the money supply. And you have to see, if you go back to that chart, and if I went all the way back in this chart to, I don't know if it goes back this far. You know what? I chose not to run it back this far to 1982. You'll see the money supply tighten. And it's why you need, I think, we're going to cover it in one last thing, the two things you need to be watching in this market to kind of gauge where stocks are potentially headed. We haven't even gotten, I don't think, Danny, I don't think we've gotten into the serious part of the Fed's policy here. I mean,
well, we're repeating the 70s almost very close. Now, whether you're late 70s or early 70s, nobody really knows. But during the period of the 70s, once we got to the other end and started the recovery, both in bonds and stocks, the bond market lost about 40% of its value, adjusted for inflation, maybe 50%, and stocks lost 60%. So we may only be 1/3 the way into this thing if it repeats like it did in the 70s and it's prolonged.
And let me explain a lot of what we're doing here. Like all the shows that we're doing, starting with 400. If you go to revereasset.com, tomorrow's insights, and if you're able to just click that podcast tab, works same on mobile. Episode 400, 401, and 402, and now 403 is building upon this. And I think everything you need to know as a consumer, and what we're just so early. I feel like we've been talking about this, Danny, ad nauseum for this year. Like, I don't think nothing we're saying is new. It's just giving people more context because, look, there's always and we've covered how to get back in. We've covered how to get rid of FOMO. Dan, Zach, was that last week's show?
FOMO?
Yeah, how to get rid of FOMO, how to ease back into the markets, and you'll never ever have to worry about missing it. So you don't have to jump in.
I think use FOMO a lot, but yeah, we can.
And look, I don't think the Fed is anywhere near done what they're going to do. And Danny, there was a rumor going around. I don't even know how they start that the Fed was going to pause in September, and then Brainerd came out yesterday and she just maybe it was Wednesday. She came out and squashed that whole notion. We're not pausing. Why would we pause? Why would we stop?
Bullard made some dovish comments a couple days ago, and I was shocked because he's normally he's a little bit.
He's a little bit more realistic. So scrolling down here, the thought here is, well, what effect does this have on the economy? And the answer is it's going to have a negative effect. I mean, does anyone regard the late 70s, early 80s, not until 82, when this finally ended, do they regard that as the roaring economy? And am I really pessimistic? And do I think that it's going to destroy a bunch of people? It's not. It's not so much the doom and gloom. It's if you're closer to retirement, your target date funds with your bonds in there. Danny, just one more time. What's happening to bonds right now, please?
Bonds are getting hit and they're going down. I mean, they've rallied a little bit the last week or two.
Just Google
Treasury bonds, but that was more of a flight to quality. But the bottom line is there's pressure on bonds. A lot of bond sectors are down double digit year to date.
Don, are you still short bonds?
Yes, we are.
Yeah.
TBT.
Yep. Via TBT. And it's because bond prices are getting destroyed. And you might think, well, I'm getting that yield, and the yield doesn't make up for the price destruction.
So let me give you a little fact. Between 1977 and 1979, Treasury bonds, which are supposed to be extremely safe and, quote, risk-free, lost 32% of their value. So if you think you're in the late 70s, you may just be in the third inning of the Treasury bond.
This is why target date funds that just automatically switch you around, or we can call them target date doofuses that work at the strip mall advisor shops next to the vape store. When they just automatically switch you in based on some antiquated 60-40 model or even less, like 40-60 or 20-80, meaning 20% stocks, 80% bonds, because you're older and you need bonds, you're getting crushed. And when you go to sell bonds right now, everybody knows you're having a desperation fire sale. You're having a going out of business sale. So what are they going to do to your price? You're not getting the bid ask that's on your screen, man. When you go to sell those bonds, you're going to get hosed. So the advisor, or maybe it's you, that were buying individual bonds. Good luck. Like TBT is an ETF, TLT is an ETF. Like ETF funds, they're fine. They're liquid. But the person that gave you the individual bonds, Danny, how big is the bond market? And can you just explain to people how that works?
The bond market is massive. It's by far the biggest market in the world. It's much, much bigger than the stock market. Most people don't realize that. And by the way, that really may be the thing that causes the Fed to pause and say, uncle, because between you, me, and the lamppost, they don't care nearly as much about the stock market as they do the bond market. It's all about the treasuries and can they issue and redeem them. Yeah, it's all about how to finance the government, even though they say they're to protect the dollar and whatever. Now, if enough pain is caused in the stock market where the constituents start to bitch at their congressman, then even though the Fed's supposed to be apolitical, they may get enough pressure to ease off, but we're not there yet.
And we're very pain adverse as a nation. We think the Fed's going to come in here and protect us. And the Fed's job right now, the mandate for them right now is to kill inflation. And that naturally is going to have a detrimental effect on the money supply. And it's naturally going to have a detrimental effect on the credit. And we haven't seen it yet. It hasn't hit yet. And look, I hope it doesn't hit. I hope that I am wrong. And that's the beauty of the markets. Like, that's the beauty of our approach here at Revere. Just because this sounds like a very bearish show. It sounds like a very heavy show. But I can change. If you've listened to me for any amount of time over the last 8 years, you can change your mind. That's the beauty of the markets. It presents you new information every day. And so maybe there is something that's going to happen that gives us a soft landing. But right now, I don't see it. Danny, if you see it differently, I know you'll speak up. And how is the Fed going to navigate? They're not a precision tool. They're a blunt force instrument. They can't get OPEC pumps more and it reduces pain at the pump. Great. But does that drive down the price? Does that drive down inflation?
Well, look, if we're very active and tactical and we make adjustments all the time, and you see some very, very strong rallies during bear markets. In fact, the strongest short-term and mid-term rallies occur in bear markets. Now, if I just had to have a pie chart buy and hold through thick and thin and not make changes, which I'm not advocating and not recommending, I would have very little equity exposure because I was going to hold for years. I would have very little equity exposure, very little bond exposure, and I would lean toward a few sectors like energy, commodities, precious metals. I mean, that's where, and I'd have less precious metals. I'd have more commodities and ag and stuff like that. But the long-term outlook at this moment is not good unless it changes. Now, the other thing you got to remember is the stock market falls 3 times faster than it goes up. So you may get such a big washout and sell-off. I have no idea. That's why we watch it all the time. But if you get a strong enough sell-off, the stock market could correct enough before the recovery begins that a rally, a long-term stock market bull market again, could get reestablished and start before the recovery always begins, because the stock market telegraphs, it's one of the best leading indicators. And that's why right now you got to be active.
And the business cycle right now appears to be in protection mode. And Elon Musk a couple of days ago tells all his people, hey, go back to the office. But then there's an email that comes out yesterday or last night, and it says, hey, we're going to cut 10% of our workforce. We're in a hiring freeze. And there's a bunch of companies that have done this. We've highlighted some of them. This is super duper painful. And, super bad feeling about the economy. And so, not that Elon Musk is the economy, but if enough people suffer enough job destruction, unfortunately, and we're a 70% service-based economy, we go spend our money on services and things, not a manufacturing economy like China's economy, then yeah, we're probably going to be in some trouble. People are going to pull in their spending hooks, and it really is I think this is an uneasy summer. I think that I don't think we've seen something. I don't know if we've seen a summer like this. I mean, maybe since '08. I don't know. I don't think it's going to get as bad as '08. It might feel that way because of the Fed just having the markets back every step of the way for the last, ever since they reversed course. And they talk about that here in this article, and I'll link to it. Don, when did the Fed try to raise rates?
When did they try?
Yeah, when was the last time?
Well, their last. You talking about? I don't know.
Fourth
on a
quarter,
yearly basis before this.
Fourth
yeah.
quarter.
Yeah, you talking about the big fourth quarter 2018? Yeah.
Yeah.
And it was like one and done.
They got down to a 20% move in the stock market, in the S&Ps, and they're like, whoa, okay, we cannot do this anymore. And that was in 2018, and the economy was humming along. Now, they're trying to wean. I don't know a good analogy, but they're trying to. I don't know if your kids watch too much TV and you're trying to wean them off of it and have dinner time discussion. Yeah, it might put up a little bit of a fight, right? They're trying to wean the market off of this unnaturalness, and it's going to be very painful. And I think it's just completely evident right now. And I think Paul Volcker said it best: or stimulate, give relief. Oh, we're going to cause more pain. Danny, how high did rates get finally before they peaked in '82?
Oh, wow. Some of the rates peaked at upwards of 20% on the more risky side, like the high yield side and some of the corporate bonds. Treasury bonds got up into the high double digit, with high teens, 17, 18%. In fact, my grandfather in 81, 82 went out on the courthouse steps. You could actually go bid an auction on the courthouse way back then on the courthouse steps to buy and he locked in some treasury bonds and hold them till maturity because he locked them in at, I think, 17%.
Yeah, and so this is the thing. Just I think we belabored the point. I was going to go on a little bit more, but I just, there's good businesses out there, and they might not be reflected by stock price. And I want to point this out. Go to my screen, Zach. Like Salesforce reported recently. Salesforce generates $1 billion in revenue every 12 days. Like this John Ehrlichman, he's a great follow on Twitter if you're into it. But this is where they started. Looks like a little house, right? They generate $1 billion.
Grainy video.
Yeah, $1 billion in revenue every 12 days. That's, if I told you that business exists, right? That's a great business. But look, that's not emblematic of what's Salesforce stock doing this year, right, Don? Like, what are a lot of the stock doing this year? Right now, I think it's.
They just had a positive reaction to earnings, but yeah, it's the high of 312, currently trading at 184, bottomed out around 155, so a 50% loss.
Yeah, and look, companies can absorb that with their market capitalizations, but you at home trying to fight for retirement can't. And we've said it enough. I'm going to say it one more time. It's about starting from a higher base. So if you find yourself down for the year, there's always a way to cauterize the wound, stop the bleeding, because the buy and holders always start from a lower point in time. You don't have to be like the crowd in this instance. And that's what makes Revere different than every other asset manager in the universe. Look, when price is going down, there are no good businesses. Just price. And the Fed has the playbook on what they're going to do with price. They're going to destroy it. That's how you get lower prices. Or artificially having the government come in and whether Danny's price fixing or which really what it is, telling the drug companies make prices lower. That's a price fix. It's all artificial. There's a natural process that kind of needs to happen here, and it potentially could be really painful. So,
well, remember 1973, you had price fixing, and so they stopped selling. They limited the supply. You literally had to wait an hour in line to get your gas, and you had gas rationing. So I'd rather have high prices and not gas rationing than a fixed price and have to sit in line for an hour and a half.
Yeah, and here's the thing too. You'll hear from old people. Historically, rates are still low. That's a different market in a different time. Well, Tim, you're comparing what Volcker did. That's a playbook. That's actually what the Fed's going to probably try and do, in my opinion. I could be wrong, and I always reserve the right to be wrong. But for people trying to come into the home market, and we're an ownership society, whether you own a home, own a stock, we're an ownership society, and that's how you get ahead in America. The price to get into a home with a mortgage is doubled. That's pretty much what happened with rates. They've done that. It's just a different scale, and you need to apply that scale to this market, not historically low. Yeah, the people trying to buy first-time homes weren't alive in 1982. That's Zach. When were you born?
Do I have to say?
Yeah. Well, you could
be honest.
You could guess it. I mean, you could give a range.
92.
92. 10 years after the interest rate peak. Zach's a young, handsome, strapping fella.
Just turned 30.
Yeah. Trying to get
ago.
yeah. And so the people trying to get into their first homes, they weren't alive when the rates were doing. They've been in this lower rate environment to the point where they were historically low. So it's just a completely different animal.
Well, let's go ahead. But here's the problem with the real estate: the lower rates have caused prices to go up so much they can't afford a home because it's too damn much. It's the Fed that caused the thing to begin with, and it's caused this bubble by the easy money printing, and now they got to cause pain to stop it. Bottom line. So what are you going to do as an at home? How are you going to handle it with this much risk in the market? There's a lot of risk. So can we get a rally from here? Sure. But you got a lot of headwinds on the longer term trend at the moment. That could change.
So with that, I think it's a good time to go to Don, what Don's seen in the market, what Don's doing with the portfolios, and what he'd like to share with you this week. Hunter is out this week, so it's going to be a lot of Don. But let me tell you about Don real quick. Don gets his notes ready. He does a video every week. It's the Big Show. Let me show you where to find it. So you go to Revere Asset. Let me show you here. You go to Revere Asset, Tomorrow's Insights. You click the Tomorrow's Insight tab. Now you can subscribe to it, right? You get the video. We have no sales pitches. We have nothing to email you.
Completely free.
Yeah. Thank you for saying that, Zach. Completely free. Like, just because it's free doesn't mean it's invaluable.
You don't even log in.
Don't even have to log in.
We don't even. Yeah.
We're so committed to not. We're so committed to being the anti Edward Revere Lehman Jones. I don't know what that is. Right. If you could put that in the title. We're so committed to being the antithesis of that you could subscribe and get it delivered to your inbox for convenience. Or you can just come to the website and watch the videos. We don't track you. We don't ask you to register. Marketing people would tell you that that's a mistake. But we feel that being your ally, being the person that you trust, is to our advantage, because stock nerds and market lovers don't suffer the things that we often talk about on the show. But we know you have your parents, your friends, your family, your loved ones that do, and you pass our show on to people. And that means the world to us, that you trust us with your loved ones. And please keep doing that. That's how we grow, through your word of mouth. And hopefully every day we earn your trust. So you click Tomorrow's Insights. I'll do it here. And Don's videos. Everyone's videos. Hunter's videos, my videos, they all show up in sequential order. And so you will see Don's right. There's the Big Show from last week. You will see Don's show up right here, top left-hand side. The Big Show. And so, Don, what are you thinking about the Big Show? Is it dirty 30? What are you doing?
It's 21 over 21 will be the focus. If you showed the title there briefly of last week's show, Big Show, which was transitioning to a short-term uptrend. Mm-hmm. And that uptrend has not broken. There have been several challenges to it, actually, Wednesday, Thursday, and Friday to the downside. A big area in the S&Ps is the 4075-ish area. Right now, we're trading at 41.07. We had a big day in the market yesterday, which was considered very bullish because there were two big pieces of negative news that came out, and the market totally shrugged them off. First one was a EPS warning by Microsoft, which we gapped down in the morning and recovered it almost immediately and finished near the highs of the day. And then, as you mentioned, Fed head Brainerd came out saying, yeah, there's no reason why we wouldn't raise another 50%, 50 basis points in September. And the market again sold off down to this 40.75 area, but it bounced right there. And it's very clear that that's a line in the sand for the market. You can notice the way you've got that line drawn there. If you look over to the left, that was the top of two candles. So it's flipped from resistance to support. See that green candle where it came into it? Yep. Now go over a little bit more. That green candle was the last time we tried to get above it and we failed. Sold off again. Got back above it last Thursday, Friday with that with the rally. And every time we're pulling back, that's containing the pullback. The market will change character if that level breaks. We've added exposure progressively this week. Accounts are at a high from this recovery off the bottom, and we're watching that level. We're just managing our positions. We're in some things that are outperforming. You mentioned TBT, which is short bond rates. Long bond rates, short bond prices. And LNTH, which is a healthcare stock that's acting well. We've got a couple of oil stocks that are acting well. And we've got our stops in place. Our downside's about 1.5%. And if that 40.75 breaks, that would be a character change in the market. And it looks like that the last couple of days where we bounced would be a bull trap. And that's what we're monitoring right now. Big level there.
All right. I'll tell you what, Danny. As we bring this show slowly to a close, don't go anywhere, stop. Because the one last thing I think is something you absolutely want to see, because it's going to be what the market hinges upon. Okay, so Daniel, give him. Can I see Danny, please? Because he doesn't ever.
Yeah, here you go.
Danny, I'm speaking directly to you now. I'm looking right.
There he is.
Can Danny see me looking right at him? I'm begging you this week, please. Just do the short show close. Don't do that long thing that you do every week. The short one, please, that gets us out a little bit quicker. So I have a little more time for one last thing.
All right, reach out to us. Thanks. Folks, if you like what you heard, please tell a friend, tell a neighbor. Just sell them to revereasset.com. Go to the top right corner. There's a subscribe button. They can sign up for our daily market insights newsletter, a short video we put out every day the market's open in the evening, and then also this podcast every weekend. It'll get delivered right into their inbox. We won't spam them or reach out to them in any way. It's up to them to reach out to us if they want a complimentary portfolio review or just want to have a topic they want discussed on this show. You can also email us, any of us, at dan@revereasset.com, Don, Tim, or Hunter at revereasset.com. And you can always call us old school at 855-REAL-WEALTH.
If you want to see the portfolios we manage, you go to About, the word About, Strategy. You scroll on down. You can see the core portfolios, the hybrid portfolios. And then Danny mentioned how to get a hold of us. And then if you're on a connected device, just touch the phone icon and you will get connected to America's fiduciary, Danny Stewart. And we take questions. We take your calls over the weekend. We work when you are available. So, look, to say the market hinges on this, it might be a little dramatic. Don would probably say it's a little dramatic. But I haven't looked purposely today because I wanted to do it live with you at home. So here's the dollar. And I think what's interesting is the dollar, a couple things that Don mentioned, that markets are holding up, that they're not giving back that 40.75 level. And what's interesting is if you I don't want to put it on a shorter time frame chart, the dollar hit resistance here, and it's holding serve. You can see it hasn't gotten above this level. And I've talked about this a number of times. If the dollar gets beyond these recent highs, you'll probably see more pain in the markets, and it's going to coincide positively correlated to TNX. And so TNX is up today 1 point. The 10-year Treasury yield, so you read this as yields are going higher, 0.95 is how you read that. They're going up. The dollar price is going up, although it hit a little bit of resistance, and that's why you're seeing markets find support. But Zach, could you go to me to the camera? I don't know if you can see the Microsoft cuts its forecast, citing effect of strong dollar. This is today's paper. This is exactly the issue, that the dollar's going higher, the Fed is cutting the money supply, which naturally has an effect of tightening credit. And if you do any bit of reading or Googling this weekend, you'll see that there's record credit card debt being taken out. And that, unfortunately, is probably not the greatest thing at the moment. So, look, we're always available to talk stocks and markets. We're always available to answer your questions, whether you're a client or not. We're here to empower individual investors, but I think you need to be watching the dollar and TNX, and of course that 4075 level that Don mentioned. Danny.
And I want to point out something. Microsoft, the dollar was higher when Microsoft reported their earnings on 427 than it is now. So I think that's kind of some BS for them to blame it on the dollar.
Are they? maybe Microsoft will blame it on supply chain. Where and I'm being a little tongue in cheek here because that's what Snap did. Snap cited when Snap gave their announcement, they were citing all the things that all the other companies were saying. And it's like, dude, you're software as a service, you're a platform. Kind of funny. All right, guys. Danny, take us away.
Folks, we'll talk to you next week on Your Money.
Barring any exogenous events.
Yeah.